Hello, everyone. My name is Abhishek, and this presentation is about technology strategy. I hope you are doing well. And before I start the presentation, I can give my background that I worked in IT for almost 10 years before joining my master's in business administration. While I was doing my MBA, I learned a lot about the strategy. I learned what are the strategy frameworks are, what is the strategy, it's a plan to achieve long-term goals and also short-term goals, especially in the conditions of uncertainty. And while reading those frameworks and how to apply strategy in business use cases such as mergers and acquisitions and other cases, I also started thinking of how we can use these strategy frameworks to decide the technology decisions, like which technology to use, whether you go for cloud provider or not, and how we can use technology to enhance our business value. There are a lot of emerging technologies. Which one relates more to our business? And I have seen that many startups they start with technology, like they choose the technology and the business, like blockchain and cybersecurity, and then they say that how we can use blockchain in cybersecurity to build a new product. And in similar, many startups they start with artificial intelligence, and then they apply artificial intelligence into several business areas. But for organizations which are already there for more than a decade or maybe 30, 40 years, they face these technologies and they need to decide that how this technology makes sense to our business. So this strategy formulation is a few step plan, and it includes, as you can see on the screen, this includes studying about technology trends. Um, there are a lot of emerging technologies, and there are a lot of technologies around, and technologies. Um, we first study these trends, and organizations identify the digital disruptions and trends around us, such as AI engineering, hyperautomation, and those things. And then they relate those things to the business context. And then comes the analysis part, and this is where strategy frameworks helps in doing the analysis. And based on analysis, we come up with some strategic options, we take a decision, and also we lay out our execution plan. So um, if we start, the first step is studying about the technology disruption. And here we identify the digital disruptions, and one of the actually easy way is that you look for the startups working in your industry and see what they are doing, and also study what are the technology trends. And technology trends can be like AI, blockchain, machine learning, those things, and now hyper automation, distributed cloud, hybrid cloud strategy. There are and these trends, many trends are across industries. So like artificial intelligence is not limited to one industry. It has actually scope across industry. And there is one more place where you can look for emerging technologies, and that is Gartner hype cycle, the hype cycle of emerging technologies. And it's a good source of knowing that what is coming up, which technology is going to take pace, and how much time each technology will take to reach a plateau of productivity. So if like actually we can say that hyper automation is like a technology, or explainable AI is a technology, then how much time it can take to reach the plateau of productivity where it will be very productive and valuable to the businesses. And in this image, we can see that explainable AI can take 5 to 10 years, and there are some technologies which are less than 2 years, like health passport. So we can see what's coming up, and we start looking into that how these start going into more details our selected technologies. But um, the important part is that not all technologies make sense to all business. So it's very important to know that the business context and relate the technology trends with the business context. So, business context is the understanding of the factors that can impact our business from various perspectives. They help in deciding that, okay, um, what is beneficial for our business. And these factors include, okay, what our business is ultimately trying to achieve. So, why it's important is because many technology trends are specific to the business context. For example, an automobile company may see few disruptions: electric cars, autonomous cars, drones, connected cars, etc., and they are more related to their industry, but they might be of less concern to other industries. In similar, for banks, they are interested in trends like open banking, fintechs, um, fraud related, machine learning for fraud, digital identity verifications. So these things are applicable to banking industry. So we looked into technology trends, we looked into the business context, and after looking into those two things, the next step is analytical inputs. So sorry, actually I'm facing some problem with this slideshow, but it's okay. So analytical inputs are like it's an analysis, and it analysis in general has three things: that okay, we take some inputs, we analyze things, and then we think over those things, we try to relate them, and then we come up with some outputs, that okay, what is the output of this analysis. So strategy analysis is done at multiple stages or multiple levels. So here I have said that I have divided into four categories. The first one is the internal analysis. So this is about actually finding the resources company has. So companies has some strategic resources which give them competitive advantage over rivals, and it can be anything like for a bank, it can be like for a Monzo bank or like a digital bank, it can be their digital platform, or even some branches located at a very high and business area can be a strategic resource for a bank. So it's an asset that is valuable, it's rare, and it is difficult to imitate by competitors, and it is not substitutable. So competitors sometimes find hard time duplicating these resources, and um, what organization do is that organization have these resources, and these are owned by organization. It can include technology, it includes officers, it includes people and everything. But then the next thing is that what organization can do with these resources, and those are called capabilities. So some organization develop dynamic capabilities, that they have this unique capability of creating new capabilities. So they combine few capabilities, they come up with a new capability. And in technology terms, you can relate that okay, you have set of APIs, you can combine few APIs, orchestrate few APIs, and build a new API that is specific to a business function, a business capability, such as like a transferring fund. So one of the framework that helps in internal analysis is called Vrio. So you actually list the resources and you see that okay, which are valuable, which are rare resources, and it's about knowing our strength, that okay, what we can do, so and what we can't do. Next is the customer analysis. Now this is actually customer segmentation is widely used in marketing by marketing people, that okay, it's a practice of dividing customer base into groups, and the individuals which are similar, such as on the basis of age, gender, interest, spending habits, fall into one group. And for example, a bank can have different groups like personal customers, business customers, youth customers, wealth customers. And um, sometimes some technologies and some feature, some new product makes sense to particular customer group only. For example, a new kind of AI based smart investor product is only for wealth customers. So we know, okay, what are the we should know actually what are the customer segments and which customer segment we target. So we done our internal analysis, we done our customer analysis. Next comes the competitor analysis. So 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 if you have heard of Michael Porter from Harvard Business School, he long time back he recognized that organizations are look keep a close watch on their rivals, but he encouraged to look the beyond the actions of competitors, but also examine what are other factors that can impact our business environment. So he identified few forces such as these are called five forces: competitors, suppliers, buyers, new entrants, and they are important because this is where you looked at, okay, what our competitors are doing. So sometimes I know actually I worked in a bank. I worked in Barclays for 7 years. My organization was looking at other startups, what they are doing, and tried to copy them, and it helps also. You can be a you can many times it is beneficial that, okay, you are the second one for launching a product, and you can do it in a better way than the first one. You also look that, okay, supplier power. So actually, like my bank was dependent on few other organizations, IT companies. They used to provide IT services. So you look at those supplier powers. You look at the buyer powers. Now customers. Now, if you are a bank, you can look into the customers that, okay, what power they have. They can switch to another bank, and and there is a threat of substitution. How likelihood is that, okay, customer can find a better way. So if our competitor has providing is helping customers to open an account with less number of touches, and more smoothly, then they are highly likely to switch to that bank for opening account. And there is also new entrants which are like disruptors. So when digital only banks like Monzo came, they had a totally digital onboarding journey since beginning. And incumbent banks were dependent on branches to open the new account. um, by doing the competitor analysis, that, okay, many banks followed the path of Monzo by building a digital onboarding journey, and it also helped them during the COVID pandemic in 2020. After competitor analysis, there's an external analysis. So there is a framework, PEST or PESTEL. It's a common framework for doing is in which we analyze what all things are there, like political, economic, social, technological, ethical, and legal factors that can affect. So there are actually new and emerging technologies which create new opportunities. In similar, there can be a change in government policy that can create a new market, and it also I can give for example, uh, while there is an example that, okay, where you want to decide which cloud provider to go, and there is some cloud provider from some country which is offering a very low prices or all the services for free, but then you know that, okay, my country relations are not good with that country, and then it can create a trouble in a long term. So these factors affect. um, so we looked at the technology disruption, we looked into the business context, we looked into the analytical inputs, and these now, based on those analytical inputs, we come up with some analytical inferences. So, which are actually, our internal and competitor analysis, they tells us what our strength and weaknesses are. So our customer base is also a strength. Our technology capability, if we have a lot of technology folks working in our organization, that is our strength. And what are our weaknesses? So maybe we don't have any wealth customer. That is one of the weakness. So or maybe we don't have IP, so that is also a weakness. And so those tells us, okay, what are our strength and weaknesses. And then there is another side of the coin, which is competitor and external analysis. And this analysis gives us the opportunities and threats in the market. So here in this example, now this is taken from a course called Strategy in the Age of Digital Disruption by INSEAD. And here in this example, a company, BMW, they know that, okay, what their strengths are and what their weaknesses are, what they can do. They have a huge market. They have a big supply chain established across world, and they have loyal customers. So those are their strengths. They have some weaknesses also. So but then they look into what's going on from the competitors and external analysis. So they see that, okay, Google and Tesla. So there is a electric cars, there are autonomous cars, there are connected cars. So AI based, cloud based cars. So now now they need to combine those things, that okay, their strength and weakness with the opportunities and threats, to come up with a strategy that, okay, where what is the best thing we can do. So So, so the technology disruption, sorry, uh, technology disruption. Wait. Um, Now, there is one more thing that is helpful here is the value chain. So when we actually are looking into that strategy, that okay, we know our we know SWOT, so strength, weakness, opportunities, and threat, and then we looked into the business area, that okay, where we want to apply, we want to do some changes. So this is an example of a customer onboarding journey, and this is how actually it was done few years back. That okay, some customer walks into the branch, they fill the application form, they submit the documents, and then operations teams set up their account, and they are communicated through a relationship manager, that okay, your account is open now. And they get some notification, and it was it used to take few days, because one day you walk into the branch, you fill the form, and then you might forget some documents, and then you come back and you submit the documents. There is a lot of actually legal, regulatory, compliance, fraud checks happening in the background. And so if you want to transform this journey, make it digital, we need to start looking that, okay, which all things we can use to transform it. Like for example, identity verification, how can be made digital. So now there are artificial intelligence services which can scan the documents. So can we use them, so that we can allow customers to upload the document and then we scan it. So account setup, that okay, how we can use actually build API services so that we can do account setup online. Application form filling, can we build a build some journey in the channel, like mobile application or online application, where anyone can fill the form and submit, upload the document, and do the account setup. And everything happens within 5 to 10 minutes time period. So we reduce the journey of days to 5 to 10 minutes. And second thing is that okay, no one has to come to branch, no physical interaction required. So 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 va- so so we need to combine this value chain with whatever strategy we are trying to make. And next is the what is the output of this. So so you can read it that okay, by most relevant strategy relevant strategy can be derived by combining the strength, weakness, opportunities, and threats with the value chain, and then seeing which options brings the most value. Now when I say value, it means like money, okay, that okay, which is going to bring more money to the business. It can increase the market share of the company, it can reduce the resource cost, or it can uh, actually it can ask customers to, or it can increase customers willingness to pay. So it applies actually in our tech strategy. So within our organization, we have business capabilities. You can assume that okay, business capability is a service like SOA service, or it's an API, and you can combine these business capabilities to build a value stream, and that value stream generate some product which is consumed by the end users. So this, if we want, we can always look into possibilities. So that we can improve these value streams. And many people think of moving from synchronous to asynchronous ways, ability to handle more requests, reducing the latency in order to improve this value stream. And when you are evaluating a new technology, you see that, okay, how this technology fits into this existing value stream. So where I can introduce a uh, event streaming platform like Kafka, and how instead of storing data in relational databases and then picking data from relational database by a BI tool and then doing an analysis, can I actually do the analytics directly on the streaming? So I reduce the touch points and I do faster analytics. So we get a enhanced value or entirely new value proposition. Sorry. So in this slide, I have tried to combine all those things that, okay, we have internal and complete customer analysis that gives us strengths and weaknesses. We do competitive and external analysis that tells us opportunities and threats. And then we decide that, okay, what are our distinctive competencies? What are the key factors for success in the market? And then we come up with a strategy, which is a differential advantage, a kind of a attribute or a attribute of a product or business, uh, which is going to be desirable in the market. So now actually we have come up with our strategy. We come up with our strategy options, and so when we will do this analysis, we come up with multiple options, and then we decide that, okay, which one is the most valuable to us. For example, a lending company did the analysis and they decided that, okay, they want to build a peer-to-peer lending business, but then there can be again few more options like a AI-based aggregator platform or a social media integrated lending platform. So this now actually, now since they know their strength and weaknesses, they know what they can do, which one is more achievable for them. Another example is is a bank decides to migrate to cloud and they have multiple options. So they can rehost, they can re-architect, or they can do some domain-driven design analysis of their system and just migrate few those systems which are the core systems where the most value can be realized. And those actually, and this value, is when also comes and if you are coming from a like a SOA background, why one of the reason why SOA was failing is that SOA services, they were all for internal use, and they were most of the technology strategies, they were not able to relate SOA to value creation. um, so they always thought that SOA services are for combining multiple systems and creating a service that directly relate to business function, but how these services can be used to generate money. And when APIs came, one of the API monetization was the primary factor. So, and companies since beginning, when they were building APIs, they were always thinking that, okay, how we can build APIs that can be sold in market. So another, actually, while doing this analysis, I find that, okay, domain-driven design analysis is also very good because it helps us identify what are the core domains of the organization and where we can build maximum value. So, so now actually, now this is actually what a strategy part is done, and then it comes the strategy execution, and so and we know that, okay, effective strategy execution addresses both the need for a long-term resource development and for the short-term strategic ability. So um, so consider the value proposition and the activities identified to bring it to the life. What resources we need to build to deliver the offering, considering both internal resources, new skills, know-how, and external new relationships. What activities and investments are going to be critical for this strategy execution, and and then be agile. That, okay. Um, like what are the key uncertainties. There can be about customer willingness to pay, there can be about costs of producing new offerings, the need to adapt new resources, and then learn curve. So whether we can do some experiments and pilots so can we can gain insights and reduce the uncertainty. So think of it as a cycle that okay, you formulate a strategy, you execute the strategy, analyze it, measure it, and then go back to formulation of a strategy. Okay. So the last slide actually, okay, sorry. This is the last slide, and here I have to combine those things that okay, you have opportunities and threats of the environment, strength and weaknesses coming from the company internal analysis. Then you combine those things, this complete your analysis. Then you formulate the strategy, and then is the execution part. So start the execution. So that's it from my side. And if you have any questions, you can comment, and I will try to get back. Thank you very much.